Inflation is just the rate at which a currency loses its buying power. The real rate of return is what you get after considering inflation. So let's say your salary goes up by 2% and your investments provide a 7% return. But inflation is at 8%. Your salary and investments will lose 6% and 1% of their buying power, respectively. It's crucial you factor in inflation and consider hedging against it. Seasoned investors have various methods to mitigate the impact of inflation on their investments, such as maintaining a diversified portfolio, opting for different asset types, and exploring higher-yield investment opportunities. This video will delve into the different types of inflation and strategies to hedge against its effects. I'm Will, and I teach people about investing, personal finance, and money. I've walked the path you seek, and today I have several businesses and investments that provide me income every single month, meaning I never have to work another day in my life. If you plan on becoming financially free, be sure to subscribe to the channel and hit the like button if you find this video valuable. Before we begin, let's try and understand the basics. You see, when people say that their dollar doesn't stretch as far as it used to, they're referring to the consequences of inflation on their income or wealth. Inflation diminishes the purchasing power of money, prompting investors to aim for earnings and investments that outpace inflation. You want to make sure you can afford more, even in the face of rising prices. Now, every country has its own inflation rate influenced by the overall state of its economy and the effects of fiscal and monetary policies. Inflation isn't uniform. It can also affect specific sectors of an economy, such as the costs of gas or food, causing a ripple effect on other aspects. So, how can you hedge against inflation? Safeguarding against inflation demands careful consideration of your portfolio and asset mix. But there exist various options to counter inflationary periods effectively. With that said, let's dive in. Option 1. Invest in Treasury bonds. Investors usually turn to U.S. Treasury bonds for the reliable income they offer. These bonds represent debts issued by the U.S. government and provide both interest payments and the return of the principal amount. The appeal of U.S. Treasuries lies in their high credit rating and the assurance that they are unlikely to default, making them a favored investment. Retirement investors often opt to increase the proportion of bonds in their portfolios relative to stocks. Holding a bond until maturity ensures that you won't lose the principal amount. It's a strategy favored for its stability and consistent income. However, it's important to note that while U.S. Treasuries generate interest income and return principal to investors, their value is influenced by interest rate levels. Interest rates, in turn, respond to inflation. The prices of U.S. Treasuries move inversely to changes in interest rates, adding a layer of complexity to their performance in the context of inflation. Option 2. Buy gold and precious metals. Gold and precious metals, valued for millennia, have maintained their purchasing power exceptionally well. Beyond their aesthetic appeal, these assets, including gold, silver, platinum, and palladium, possess enduring value. They are easily tradable in liquid markets, durable, and malleable. Despite volatility due to global events, as both nations and investors hold these assets, they serve as reliable instruments. Unlike the past when the U.S. dollar was backed by gold, it is now a fiat currency, devoid of physical commodity backing. Nevertheless, gold and precious metals have historically resisted the devaluing effects of inflation, making them resilient stores of value. While not income-providing like bonds or dividend-paying stocks, they still find a place in modern portfolios and tend to be favored during inflationary periods due to their historical ability to preserve purchasing power. Do you hold any gold or precious metals? Let me know in the comment section below. Option 3. Fund a high-yield savings account. High-yield savings accounts are like upgraded versions of regular savings accounts, giving you better interest rates, especially when compared to the ones at traditional banks. Online banks, which offer fewer services but better interest rates, have become quite popular. To get started, you usually need to deposit a minimum amount, often around $5,000, but in return, these accounts provide you with more favorable rates. While high-yield savings accounts might not be the main focus of your investment plans, they're a handy option for managing your money, especially when it comes to setting aside funds for unexpected situations like emergencies. This becomes even more important when you think about how traditional banks usually offer lower interest rates, making high-yield savings accounts an appealing choice for people who want to get more out of their savings. Option 4. Invest in the stock market. Inflation and increasing interest rates have the potential to affect stocks and may even contribute to economic recessions. However, it's important that you not too hastily sell off all your stocks. Historical evidence has consistently shown that long-term investing in stocks is a beneficial strategy for accumulating wealth over time. During challenging economic periods such as inflation or recessions, having a diversified portfolio is crucial. This means spreading investments across different types of assets to reduce risk. In the context of domestic stocks, maintaining a diversified portfolio can act as a safeguard, providing protection against the impact of inflation on specific sectors. Strategic adjustments to portfolio holdings and sector weightings become essential during uncertain economic times. These adjustments can offer additional protection by aligning your portfolio with the changing dynamics of the market. You should look to explore various options, including dividend stocks that provide a consistent income stream, consumer staples companies capable of passing on higher costs, and real estate investment trusts, which often show resilience during economic fluctuations. By carefully considering and incorporating these elements into an investment strategy, you can navigate the challenges presented by inflation and rising interest rates while aiming to maintain a robust and balanced portfolio. International stocks provide an effective avenue for diversification, offering a way to spread investments across different regions, particularly in countries with lower inflation rates. This diversification acts as a strategic hedge against domestic inflation, as economic conditions and factors influencing stock performance can vary between nations. Investing in international stocks becomes a valuable component in managing risk and promoting stability within your portfolio. Another profitable strategy involves dividend-paying stocks. Beyond providing a consistent income stream, these stocks can serve as a hedge against inflation when you choose to reinvest the received dividends. This reinvestment helps compound your returns over time, potentially providing a more effective defense against the eroding effects of inflation on your purchasing power. For more information on this, I'll link a video at the top of this one for how to actually build wealth with dividend investing. Furthermore, investing in mutual funds and exchange-traded funds offers a convenient way for you to access diverse stock portfolios. These investment vehicles pool together money from various investors to invest in a range of stocks, providing instant diversification. Some mutual funds and ETFs are specifically crafted to protect against inflation, offering you a specialized tool to navigate uncertain economic climates. This targeted approach allows you to tailor your portfolio with instruments designed to withstand and potentially thrive in the face of inflationary pressures. Option 5. Buy real estate or alternative investments. Investing in real estate can be a wise strategy for safeguarding your wealth and hedging against inflation. Unlike other assets, real estate has a tangible and enduring nature, providing a sense of security even in fluctuating economic climates. The value of real estate tends to appreciate over time, acting as a reliable long-term investment. Additionally, a rental income from properties can serve as a consistent cash flow, offering financial stability. In times of inflation, real estate often outpaces the rate of rising prices, serving as a hedge against the eroding effects of declining currency value. Diversifying your investment portfolio with real estate not only helps mitigate risks, but also provides a physical and tangible asset that can withstand economic uncertainties, making it a prudent choice for wealth preservation. Another way is through the purchase of certificates of deposit, or CDs. Now, just like high-yield savings accounts, CDs provide elevated interest rates compared to traditional savings choices. However, akin to bonds, it's essential to note that the longer the maturity period of a CD, the greater the risk of losing purchasing power due to potential increases in rates associated with inflation. Buying cryptocurrency is another option. If the U.S. dollar is losing purchasing power to inflation, cryptocurrencies can serve as a potential hedge, often viewed as a safeguard against weakness in the U.S. dollar. Bitcoin is a prime example right now, as Cathie Wood from ARK Invest believes it could reach $1.5 million by 2030. In general, the most common asset classes for safeguarding against inflation include gold commodities, a well-balanced and diversified portfolio with a 60-40 split between stocks and fixed income, real estate investment trusts, income and appreciation from real estate, the S&P 500, and Treasury inflation-protected securities. To find out whether the S&P 500 is still a worthwhile investment, watch this video here.